like to say good evening and welcome you. For those of you who I have not met, my name is David Thomas, and I am the Dean of the McDonough School of Business. A few months ago, I would have said I'm the new dean, but it now feels like I've been there a long time, and I'm enjoying it greatly. So it's great to have you here. I'm pleased to get the opportunity tonight to also continue to get to know more and more of the alumni, in particular of the McDonough School of Business, but also more broadly, Georgetown University. Tonight is, I think, an especially important event for us because it represents one of the aspects of the McDonough School of Business that I hope over the next few years we can really build upon. And that is the fact that we have at the McDonough School of Business a number of faculty tonight represented by Reena Aggarwal, who many of you know, but also importantly, our Center for Financial Markets and Policy, where what we're attempting to do is to have the McDonough School of Business become an even more important voice for conversations that need to happen about important things affecting the intersection of business and society. And tonight's conversation represents one of those kinds of conversations in which we want to bring together practitioners, academic thought leaders like Reena, as well as people who've been connected in the policy domain to begin the important discussions that we think have to happen both in the context of the U.S. as well as globally, if we are to move forward the world's economy. So that's so for me, this is a very important opportunity. In a few minutes, we will participate in this dialogue. Our Office of Alumni Relations is pleased to host this panel with our Georgetown Center for Financial Markets and Policy and the Financial Times. And thank you for the support of the Financial Times in this effort. Our illustrious panelists will discuss the role of capital formation in job creation, trends in U.S. public markets, and the role of private equity. I'm grateful to Reena, our McDonough Professor of Finance and the Director of the Georgetown Center for Financial Markets and Policy, for assembling this panel. The Center for Financial Markets and Policy provides innovative and impactful thought leadership for global financial markets. It hosts dialogues, conferences, and events like the one this evening and plays a leading role in the creation and dissemination of relevant and rigorous research on critical policy and regulatory issues. Before I turn the microphone over to Reena, I want to share with you that she is receiving a very significant honor tomorrow from the Wall Street Alliance, which I know many of you are part of, and hopefully many of you will be there tomorrow to celebrate her getting this award. And I should say it's particularly important because she is the first faculty member at the McDonough School of Business to be so honored. And that says a lot because the Wall Street Alliance is an alumni organization that I think, at least as I look at the people who've been recognized in the past, looks out and sort of asks a few questions. Who are people that are connected to Georgetown, who have had a significant impact on the world, in particular the world of practice, and secondly, people who in some way have had a significant impact on our alumni and their lives as they've unfolded. And so it's a great honor, I think, that the Alliance has chosen to honor Reena tomorrow night, and hopefully many of you will be with us. Now, ladies and gentlemen, without further introduction, I present Reena Aggarwal. Thank you.
Thank you, Dean Thomas. I would also like to acknowledge the productive partnership that the McDonough School has had with the Financial Times. The center has now organized several events with the FT, and they've all been wonderful events. I'm most grateful to our panelists for joining us this evening to discuss a topic that's critical for our economy. If I try to introduce the panelists and do the right honor and really talk about everything that they've done, I'll end up taking the whole hour. So I better not try to do that. Please refer to the program brochure for all the details. The panel is moderated by Telis Demos, US Markets reporter for the Financial Times. The panelists include Kathleen Casey, former commissioner of the Securities and Exchange Commission, and Kathy is now a distinguished policy fellow at the center. Mario Gabelli is the founder, chairman, and chief executive officer of the New York Stock Exchange listed firm, GAMCO Investors. Mr. Gabelli is also a Hoya parent. Laurence Tosi is senior managing director and chief financial officer at the Blackstone Group. LT is a triple Hoya and serves on the advisory board of the center. Let me hand it over to Telis. Thank you.
Thank you, Reena. Capital formation has been a critical discussion in the past couple of years as the economy bounces back from the trauma of 2008. And one notable way in which we're still waiting to return to that sort of pre-crisis era is in the number of companies that are going public. And so capital formation and this question of how and where companies get equity capital from has been discussed intensely. So Reena, I wanted to throw it back to you and ask you why capital formation is in focus to the degree that it is, and why it's such a critical part of job formation and how it's been changing recently.
So, many years ago, when Microsoft went public, I could very proudly say that the United States has one of the few markets where a company like Microsoft can go public and raise capital. At that stage, the company could go public, raise capital, expand, and create lots of jobs. So small companies over the last 3 decades, these firms that are less than 5 years old, they've created 40 million net new jobs. 90% of job creation for public firms, it tends to take place just after a firm has done an IPO. So companies like Microsoft, and now Facebook has filed for an IPO, they really represent the spirit of entrepreneurship, they represent innovation, and they bring about job growth. Since 2000, I'd have to say that it's become really difficult for companies to raise capital. And I'm going to give some statistics here. New businesses being launched has fallen by 23% in the last 3 years. Share of IPOs that were smaller than 50 million, they fell 80% in the 1990s. They fell from 80% in the 1990s to 20% in the 2000s. Fewer VC-backed IPOs have taken place in 2008 and 2009 than in any year since 1985. Number of IPOs every year since 1997 is less than the number of companies leaving our stock exchanges. US IPOs have not kept pace with the size of the US economy. In 1991, there were almost 7,000 companies that were listed. Now there are more like 5,000 companies that are listed. And at the same time, I would argue that the global IPO market is not suffering so much. It's the US market that's suffering. So that's a problem for job creation right now. But really my bigger concern is, what does this mean for US competitiveness 10 years down the road? What does it mean for innovation 10 years down the road? What does it mean for entrepreneurial spirit 10 years down the road? Is this sort of going to be our last decade? And towards the end, we'll end with a happy note. I don't think that's the case, but I do think we have to pay attention, and there are certain things that we can do to make sure it is not the last decade.
Well, before we get to more happy talk, which we will, let's focus a little bit more on some of the reasons that companies are finding it difficult to go public. And I wanted to ask you this, Kathleen. What were some of the hindrances that companies faced going public that you and other members of the SEC have identified and sort of been thinking about in the last few years?
Well, thank you very much, Telis. And I also want to say that I think it's really great that Reena highlighted all of the statistics, because I really think that it's important to appreciate those numbers and giving context to what we face in terms of the ability of the interest and the ability of companies, particularly small companies, to go public. I think that the broader concern with the decline in U.S. IPOs has been sort of front of mind, largely since I would say the passage of Sarbanes-Oxley. There was a great deal of concern raised about what the likely impact would be by virtue of many of the new requirements. In particular, Section 404, which requires internal controls to be conducted by management and then also attested or certified by an outside audit firm. Enhanced corporate and personal liability, which also certainly raised the cost of being a public company. I would say that certainly post Sarbanes-Oxley, you've seen some of the trend in the numbers that Reena has noted, and Sarbanes-Oxley, I would say, is consistently highlighted as one of the primary legislative and regulatory issues that have affected companies going public, although I would tell you that there are differing views still today on how much influence Sarbanes-Oxley has had. I think also, and I would put Sarbanes-Oxley in the context of broader regulatory burden and cost of going public. I think it's been noted that, and I think the IPO task force in particular has noted that the average cost is like $2.5 million to go public, and I'll defer to others who maybe more have different views on that. And then the annual cost is $1.5 million after that. So again, it is certainly a fair cost in going public. And we are talking about smaller firms in particular. What we've heard is that, not surprisingly, that additional regulatory requirements that aren't particularly scaled for small and medium-sized enterprises have a tendency to be disproportionate for them in meeting them, and then obviously in being able to meet the cost of being a public company, both in terms of the IPO and then going forward. So certainly regulatory burden and the legal and the litigation environment are always going to be factors. And I would say that post-SOX, and you see most recently with the passage of Dodd-Frank, that trend continues, and it is cumulative. And maybe we can discuss that a little bit later in terms of some of the requirements in Dodd-Frank and some of the burdens I think that smaller companies will continue to face unless they're scaled. The other, I think, that's been really interesting is that there's been a lot of concern raised about whether or not existing market structure serves smaller cap companies versus larger cap companies in particular. And when the commission started its process of considering market structure issues back in 2010 now, almost 2 years to it's January 2010, this was one of the key areas that I know I personally found most interesting, given some of the comments and input that we received from some particular voices. And here again, given the data, if you look at some of the data on smaller companies, smaller issues tapping the public markets, I think you see that decline is more acute. And if you look at some of the changes in the in the market structure, the economics of trading in particular have changed, and a lot to the good in terms of the efficiency of the market when you talk about liquidity and, again, like I said, efficiency, lowering transaction costs, reducing spreads for larger cap companies. But what we've also seen and heard is that you've seen a real dearth of liquidity for smaller cap companies and less of an incentive for market makers and others to trade in smaller cap companies. And so this is something that I think that the SEC is continuing to consider, I hope, as part of the market structure review that they're doing. But it's also, in many ways, I think, leading many people to consider whether or not if changes need to be made, is it possible to think about facilitating alternative listing requirements for smaller companies. And that's also part of what is being contemplated. So again, I think that when you see the change in electronic trading, the fact that it's harder for smaller cap companies to attract investor interest, market makers and institutional investors are not incentivized to trade for various reasons, that exacerbates price volatility. And again, that ultimately makes it more difficult for small caps to ultimately go public, I think. The other element that we've also found is that it's sort of a confluence of events with the adoption of regulation fair disclosure, as well as the global settlement on research, sort of acting in concert to further reduce the amount of research coverage you have, and again, more particularly for smaller cap companies. And so a lot of focus is also being given to whether or not something more needs to be done to incentivize research. And this has been an area where the President's Council, for example, on Jobs and Competitiveness, has recently suggested right-sizing Reg FD and the global settlement to try to address what has been recognized as, again, a lack of research, which makes it harder, again, for smaller caps to attract the demand they need or the demand that investors would have for those caps. So those are some of the big issues I think you see. There are a lot of others as well that come to play, not just on the public side, but also on the private side. And I think, though, that those are some of the primary drivers right now in affecting the incentives.
Well, and obviously, and you mentioned the private side of things being one alternative, and what's interesting about global markets these days is that, of course, what happens in the U.S. doesn't happen in a vacuum. Companies, the U.S. is in a sense competing with other countries to win those listings. So some of those market structure issues and regulatory issues don't apply in other countries. Mario, do you think that we've seen other markets, especially mainland China, for example, which is sort of a closed, unique market, has been raising quite a bit more money for small companies than we've been doing here in the U.S. We've also seen some big companies, particularly European companies, even Manchester United, opted to go to Hong Kong to raise capital. Do you think that are the difficulties that we're having here in the U.S. sort of pushing the balance of capital formation eastward?
Let me echo Dean Thomas's congratulations. The Wall Street Alliance seems to have taken some smart pills finally. Look, I'm very simple. They start off with a basic premise that where are the jobs being created? Small business. How does small business get started? They start because somebody has an idea, they raise capital, and they basically then want to monetize it. But where do they raise capital? They need it from angel programs, or they go into the venture capital world and they have early stage, late stage type capital, or pipes, but they want to make money. So if you're starting a venture capital firm, a VC firm, you have to have a record. To have a record, you have to make investments. You're going to have some losers, you're going to have some winners, and you want to have a return, and then you want to go to the state retirement systems and other funders. And one of the ways to show that record is to sell something. And to sell something, you need competing bids. One of the ways to get competing bids is to have a public offering and say to a company, look, you don't want to buy me at 20 times EBITDA? Then I will go public. And if all of a sudden everybody says, you want to go public because you got this rule, this rule, this rule, this rule, and you, why? So that's basically a chokehold that has to be eliminated. I mean, it's not very complicated. Abolish Sarbanes-Oxley. Just because you had Tyco, Enron, and WorldCom, yeah, we had those. And did that start all of the problems that we had with MF? That's not a bad word. It's the name of a company. And essentially, and maybe it is a bad word if you were to have had some money there. Basically, so where do you go? Take New York. They had scale in terms of lawyers, accountants, investment bankers, fundraisers, financial individuals that created wealth and created opportunities for companies. So they go to London. They go to Dubai. They go to Hong Kong. And as they build up scale and as they get comfortable with that process, you lose share of market. The New York Stock Exchange. I was on the board of the American Stock Exchange for 10 years, so we had alternate vehicles for these. The New York Stock Exchange, we're going to call the Deutsche Derivatives Exchange, if the way the world is going. And, you know, the nonsense of allowing May 6th to have occurred and to damage investors' confidence in the public markets, and nothing's happened since then. So who are the investors? Do we cater to traders or do we cater to investors? And how do we raise money? And how important is this process? You know, Schumpeter wrote about this years ago. He was a professor at McDonough, wasn't he? With the concept of creative destruction. And so we're just going through these cycles. Some of it is cyclical, some of it is secular. And the answer is we have to compete, and we're losing.
And of course, the other, you know, going abroad isn't the only alternative. There is quite a bit of money in sort of private markets these days. We saw, obviously, Facebook survive for many years before going public by staying in private markets where they found some liquidity so that early stage investors and others could transact. And of course, we have private equity firms that have raised you know, tens, if not hundreds of billions of dollars to essentially buy companies from the public markets and sort of see them through, you know, various stages of growth. Do you think that there are viable alternatives for capital formation to the public markets? Are we too focused on that and not focused enough on, okay, well, how can we allow other structures to step in and you know, provide some of that nurturing for small companies?
A couple things. First of all, I'll try a tactic that never worked when I was in Reena's class, which is not to answer the question. I never got away with it, but I'm still trying. But I'll put a little fuel on the fire, Mario and Kathy, because I think you made a couple of points. So I'll start with my victim comment. So we recently went public in 2007, and I actually have some stats about what that experience was like. And I do like your Sarbanes idea, given that I have to sign financial statements and my life away. But in the year that Blackstone
By the way, we both have to sign.
That's true. That's true.
We went public in 1999, and would we do it again? But any event.
That's actually a good question, and I'll get to whether asset managers, it's even more difficult because of our business model. In the year that Blackstone went public, we paid $120 million in fees and expenses related to going public. So if you think about that, that was about 8% of the entire firm's profitability that year. It's a pretty staggering number. Today, we spend about $50 million a year on lawyers, accountants, and other things related to being public as a public company, which is about 8% of our profitability in calendar year 2011. Those are very scary numbers. I appreciate the $2.5 million to start up on Sarbanes and the $1.5 a year. That's really applies to a relatively, I think, a relatively simple business model. If you take the 5,000 companies that are public, 1,000 of them have less than $100 million in revenue, so it's a little bit different. It is a staggering expense. I'll give you another little fact. We now have spent almost $40 million on legal fees related to plaintiffs' lawsuits associated with our IPOs for theories of the case that I still don't completely understand. This is a very unfriendly environment to go public in. Would we change things as a public company?
Sure.
I don't know. Would we like to have different rules? Sure. Are there some benefits to being public? There are. But being a resident partnership here in the United States, we really didn't have an option. And what we're seeing more and more now is, particularly with our portfolio companies, is they are seeking alternative levels for capital. And let me give you a couple of stats. I did do my homework, Reena. So, and I'll get to capital question. I'll finally get to it. A couple of thoughts. First of all, when you think about capital, I think you can't just think about private equity firms, I think you have to think about private capital. The entire private capital industry in the United States is $1.2 trillion. That is a speed bump to any type of downturn or need for capital in the markets. It is still, the private capital market, which private equity, real estate, and venture, is tiny in the United States. At the time of the downturn, when many of the banks were struggling, the government reached out to firms like mine to see if we could help. The reality was we just weren't big enough, and there was no way the entire industry couldn't save a few of the companies that were going forward. So without a real functioning capital markets, you get a much more volatile time. Now, that said, private capital can be patient capital and good capital. I think in the case of Facebook, being able to take an idea that was unprofitable for its first several years, that was what was sold on a dream, is something that's very important. But you have to reward that risk in the market, and you have to make the equity markets at least hospitable enough for an exit. So let me give you a couple of stats around the private capital business. Only 14%, since 1970, only 14% of private capital investments resulted in IPOs. In the last 5 years, that's less than 5%. That's a pretty scary trend. That means if you follow your way down, that certain, I'm sure the last few rounds in Facebook, in fact, I know one of the reasons why people were willing to pay that valuation was because they could see an end in sight. When that changes and gets more difficult, or in our case, much more expensive, each subsequent round of capital gets more expensive because the exit becomes a little more difficult to get to. That has a cascading effect on private capital being available. So while I think over time, there needs to be a better balance so that there is a functioning capital markets. And I'll make one other comment, that capital is very fast moving. So right now, if you look at private capital, the private capital industry, which let's call it alternative asset management, private equity firms, 80% of those firms by assets are in the United States. They've been growing at a better than 20% annual rate since 1990. That makes it one of the fastest growing segments of the American economy, yet you can see it hitting a wall if you continue to have difficult private markets. That said, as the banks have retreated a little bit, you're starting to see other players come into the market. You're starting to see sovereign wealth funds. We're starting to see more types of private capital playing in different parts of the capital structure. Typically, private equity and venture buy a business, they control it, and then they take it public. What we're seeing now is replacing the banks, which are really struggling. You're seeing more private capital poured into mezzanine and lending and other types of debt structures. So there are signs of growth, but at the same time, there are signs that capital is fleeing. Last year was the first year in the history of our firm when we put $13 billion to work last year. Last year was the first year in the history of Blackstone that more than 50% of that was outside the United States. And that doesn't mean that we're cynical about the US, that just means that actually the path to liquidity, if you will, seems a little bit clearer. And I'll finish with one last thing. When you introduce uncertainty to capital markets, capital flees. So to the extent that the rules are changing, or it's uncertain what something like a Dodd-Frank, what impact it will have, the only choice you have as a new investor is to avoid that uncertainty, because it's unquantifiable what will happen, and I think you're seeing some of that impact. So,
Yeah, let me hitchhike on that before we get off it. You talked about being sued. How do we solve the problem? Because if you're an Asian or you're a European or you're someone else, why go public in the United States when the rules are against you? Losing party doesn't pay. So how much, take the English system. If someone were to sue you and they knew that if they lost, they would have to pay your legal fees, how much would your legal bill have gone down? Probably 80%.
well, I mean, and you know, Mario, what you see is it's really not a game of who's right and wrong. It's a game of whether or not they can make the case that the infinitesimal chance of 1% winning will cost you a disproportionate amount of damage to your shareholders. That's the conversation you begin the settlement talks with, which is, well, yeah, we have a crappy case, but 1% chance could cost you billions. So, and it's really that kind of systemic inefficiency in that market that makes it difficult. If any of my classmates from law school are here, I don't apologize, actually.
Oh, that's right.
Yeah, just to follow up on a point that LT was making about uncertainty. I think the uncertainty is just terrible. Because there's uncertainty about so many things, investment is not being made and decisions are not being made. and talking about regulation, it's really hard to keep up with your former students these days, but I'll try. Talking about regulations, so when the American banking system was set up way back in 1864, the regulation was 29 pages. Okay. Federal Reserve Act of 1913, the regulation was 32 pages. Glass-Steagall, 37 pages. Dodd-Frank, anybody wants to make a guess? 8,488 pages. Okay. And I think it's not just sort of Dodd-Frank is out there or Sarbanes-Oxley is out there, but a lot of the rulemaking for Dodd-Frank has not happened, and that creates a lot of uncertainty. So people are still trying to figure out, what is the Volcker rule going to mean for me? Okay. And businesses want to be played carefully, want to be safe, and they're getting rid of proprietary trading. There's so much of the rulemaking has not happened with Dodd-Frank, and that creates a lot of uncertainty for businesses. What do we do?
If I could just, I know Telis, you had the question, but again, on this point, which I think is really, it really is quite important, which is the uncertainty factor and how that affects decision-making. And I think that, one of the things that I became more concerned with was, even if you look at Sarbanes-Oxley, and, that was viewed as quite landmark at the time, and quite significant and quite burdensome and costly, although again, folks have varying views of that cost-benefit analysis. I think Dodd-Frank is, on a scale that we haven't seen in recent times. And I think that part of what we need to be concerned about, as much as the substance of what is in Dodd-Frank, and a lot of people still don't know. I mean, I do. I spent a lot of time implementing it while I was at the commission. But I think it also speaks to process and to trends in regulation and legislation. And this is what I think is more fundamental that I think we need to think about trying to change. You hear a lot of the talk about, well, you have this pendulum swing, right? So we have this crisis or scandal, quick response by Congress or regulators sometimes to try to respond to the perceived issue. Oftentimes, there is not necessarily a full understanding of exactly what the problem was that is being addressed, or it hasn't been necessarily proved up. And then secondarily, I think that there is this tendency to have a very broad brush approach to addressing the issues. So even when you talk about Dodd-Frank, there are many provisions in Dodd-Frank, while purportedly intended to address concerns raised in the crisis, particularly even in the financial services side or financial firm side, it affects Main Street as much as it affects Wall Street. And I mean, there are provisions in there that have to do with reporting on conflict minerals, which is completely unrelated. Again, it's noble social cause, but is that appropriate place for, addressing it in the securities laws? Very costly, very complex, very difficult for issuers to ultimately comply with. And again, the regulators are struggling with this as well. So this is a process issue, I think, as much as anything else, both from the policymaking side, when Congress chooses to respond, as well as regulators, and the process that they use in implementing legislation, especially where so much discretion is left to the regulators in filling out the requirements. And then again, this leads to the kind of extended uncertainty that you see that'll be years in the making. So again, I do think that this is an area where both Congress as well as regulators need to give further thought. And I do know that there's been some focus on this by the President's Council as well, in terms of trying to have more fundamental regulatory principles that we operate by, understanding that oftentimes it's very heated political environments that drive these outcomes. But once a law is passed, it is so hard to change it. And I think that's even a testament here that we're still talking about 404B from Sarbanes-Oxley, how many years later?
Before we continue discussing, we've sort of gone over, we said we were going to talk for a couple of minutes and then throw it open to questions. We've obviously done a little bit more than a couple minutes of talking up here. So I just wanted to, before we go forward, I want to throw it to the audience to see if there were, any sort of questions that our discussion so far had raised, or any points that any folks wanted to make.
Hi, Commissioner Casey. One of the things that many people have brought up is Dodd-Frank and other new regulatory rules, which are voluminous. The Director Kuzami has much more power, and the SEC has much more power than they had before, and they don't have any budget to hire people to enforce that. How can we deal with this where we have a regulatory regime that has all these rules, which many of them are unformed, and a regulatory body that is not being budgeted to enforce these rules?
Well, thank you very much for your question. There's no question that Dodd-Frank has imposed tremendous new responsibilities and obligations on the Commission in terms of not just implementing new rules, but also exercising new authorities. And key authorities where I think that the Commission would be quite challenged in meeting them, I would say even with 500 new people. And that's just because I think it has to do with capabilities as much as it has to do with bodies. And that's really important. So I think budget issues are always going to be a challenge for the agency, even though if you recognize at around the time of the passage of SOX, the agency's budget, I think, doubled at least over the course of those years. And there's no question that the Enforcement Division is where much of the agency's resources have gone historically. It's one of the largest part of our budget. And so I know that that'll continue to be an issue in future budget submissions to Congress in ensuring that the Commission gets the resources that they need. But I think just as important as focusing on how much money, which ultimately translates into people, is necessary, it's also making sure that the agency is doing everything that it needs to be doing with that money. And I think that's also been part of the challenge for the agency in demonstrating that. Certainly in an environment through the crisis where many folks were, took issue with the performance of the agency fairly, and I think in some instances, and unfairly in others. So I think that, to be truthful, I think Dodd-Frank really puts the agency in a quite difficult position. What was already a challenging mission for the agency to continue to be successful, and I think it's only been exacerbated. Certainly, like I said, with some of the new responsibilities that the agency is going to have, will further test that. But I think for Congress, to the degree they have expectations for the agency in meeting its objectives, I think you have to be very clear about what those are in terms of what the agency can deliver, and then give the Congress some confidence in the accountability of the agency in meeting them. And that's obviously something that the agency is going to have to continue to do in justifying and seeking the resources it needs to fulfill its obligations.
Thank you.
I would appreciate whoever is asking questions if you would introduce yourself, please.
Just to
I had a question right here in the front, but after that comment, he doesn't want to introduce himself.
Just on the topic of regulation, there have been some proposals to fix a few of the things we've talking about. Maybe not, none of them really would address what Laurence and Murray have raised about the difficulties of being a public company at any size. But there are some proposals in Congress at the moment which would create what a lot of people are calling an on-ramp for small companies, that they would be exempt from Section 404 for a couple of years. As well as a couple of other changes that, for example, that they would be, I think somebody mentioned it, the Spitzer, the global settlement, which restricted banks from using their analysts to promote companies that they were taking public. Do any of these, have any of the changes that have been discussed strike anybody as being particularly critical or important ones? And do they, do they do enough, or are these just kind of Band-Aids on a system that maybe needs more fundamental change?
I I don't think it's one bandage that's needed. I think it's a portfolio approach. You need a number of different things going on at the same time. So I do like the movement towards making the Reg A exemption go up from 5 million to 50 million. It's something in the right direction. I do like the proposal of companies that have a market value of less than $1 billion, remove SOX 404 requirement for those companies. They're not, huge companies, so remove it at least for those companies. And I must say, I know we're doing a lot of sort of bashing of regulation and what's going on in the US markets. And I kind of wondered how much of it has to do with what's really happening in the US versus what's happening outside the US. So the way I tend to think about it is the US used to be here. In terms of capital markets, we were the envy of the world, we were here. The rest of the world was down here, and the spread was really high. Right? So is it so much that the US has come down, or the rest of the world has caught up, and the spread has really narrowed? And I think it's a little bit of both happening. If we hadn't had this crisis and the economy was, growing at its normal pace, then we probably wouldn't be having some of this discussion. So on the positive note, I think the labor market is starting to improve a little bit. And as the economy picks up, I hope some of this will not be an issue. And some parts, we sort of dump it as Sarbanes-Oxley is good or bad. Dodd-Frank is good or bad. And really, these are complex regulations. Some parts were needed, and my own research shows that some parts were actually very beneficial. And then some parts have become extremely costly, and there's uncertainty related to what hasn't been resolved.
Yeah, Mario, I wanted to put this to you as an investor, as somebody who evaluates public companies and looks at them all the time. Do you think that maybe that there is a danger in throwing out some of the protections that have been there, especially for smaller companies, which sometimes can be the riskiest, in trying to pump up these markets when in fact maybe there's a cyclical or kind of global element here that maybe is a bigger factor?
Well, our research focuses on the unloved and the ignored. So we like small companies that no one follows, so we're all in favor of barriers to entry. But at the same time, take something as simple as eliminating 404. But if a company isn't 404 compliant and wants to sell to another company, you also have to have other rules that tie it in. And no one wants to get rid of rules. I want full disclosure of what Carl Icahn is buying all the time. I want to know what Warren Buffett's buying all the time. And I want to know what these organizations that buy the debt and get a juggerhold on companies, they don't report. So yeah, I'm in favor of rules. Insider trading, nobody wants to eliminate insider trading. Why should somebody get an edge by buying somebody any event? We're being televised here. And the rules are good. The problem is you have to understand them and you have to anticipate them and you need time to study and implement them. And if you change them every 6 years or 3 years or 12 weeks, it's a challenge. I didn't answer your question, so I took a page from LT's playbook.
Any questions from the audience? Sure, this gentleman up here.
I'm Max Blandon. I've been in business for 25 years, and LT I sat and heard. He was one of my instructors back at Georgetown. I've raised about $50 billion of capital all over the world, in Asia, Latin America, and the U.S. And my question is, it all evolves around who's the adult in the room in reality, right? Because what we're seeing here, and I take Reena's point, is that we seem to have taken the political discourse in this country and slapped it down on the commercial business world, and now are trying to drive a wedge into what's the most important thing, which is to create jobs. And so my question to everyone here is, who's really the adult in the room? Because we have Commissioner Casey on the government side, we have Mario on the investor side, we have LT on the investor, private equity side, but the reality is all of us are being torn apart by this terrible discourse. And who's going to actually be the adult who's going to drive the process so that we can create jobs, we can be competitive, Because I can tell you unequivocally, having raised money in the U.S., having raised money for clients in Latin America, and having raised money in Asia, no client today is going to be saying, first choice, I want to go raise money in the U.S. They want to raise money everywhere but the U.S. So my question stands, who's the adult?
Well, I'm going to ask you to answer your own question. Why are they putting the U.S. in the second choice? Is it because they know that they're going to get sued? Is it the regulation? Is it the personal risk that they can not be handcuffed, literally, in markets like Dubai or?
Well, I think the answer is all of the above, right? If you know, the way I thought, the way we think about it is raising equity has two functions, especially for mid-sized companies. One is to get access to liquid markets and new investors, but more importantly, and LT knows this quite well, is to have a currency to allow you to acquire other companies. But if the downside is that you're going to go in and be forced to sign your life away and potentially be thrown in jail because somebody down the ladder made a mistake, nobody is going to take that kind of a risk, especially when you have competitive markets in other exchanges that are much more lenient towards those kinds of issues. So we seem to have lost the plot in what is really important here, which is to have companies have access to capital from the institutional investor as well as the retail investor, and we've lost the plot completely. So my answer to you is all of the above. Investors don't want to take any of those risks.
Telis, he did a good job answering that question.
I was just going to make a comment, which is, it's my sense, and you can, I think Reena made a good point here about, you know, what necessarily is contributing to the current environment and why there's so much focus right now on capital formation and job growth. But accept that for what it is. I think what you will find, however, is that that is one area where you find a fair amount of bipartisan support. And so when you're talking about entrepreneurship, when you're talking about small business, when you're talking about the engine that drives job growth, that is one area where I think you actually have a fair amount of consensus. Not so much on on all of the different proposals, but at least the spirit of feeling that this is something that needs to be addressed. So that's why I think you can see, by virtue of some of the recommendations that have come out of the President's Jobs and Competitiveness Council, the work of the IPO task force, which came forward, was immediately converted into legislation, passed the House like 421 to 1. So you see votes like that where, again, there's a lot of interest in trying to address what is recognized as an issue of concern. And so I guess that's why I take a little heart there. Whether or not you agree with, again, all the different proposals, there are differences there, but I do think that this is one area where there's some commonality, and that the politics are working in concert to support addressing these issues. So that's just an observation.
To switch gears a little bit, LT, I want to throw this to you. To just bring it a little bit back to the jobs question. If our interest is in creating jobs, in allowing new businesses to flourish and create, industries or subsectors and things like that, corporations right now are sitting on a tremendous amount of cash, and there are many opportunities. A lot of entrepreneurs will say, one of the reasons I don't go public is because I can sell for a pretty good price to a big company. If it's a tech idea, it might be an Intel or Apple. Are there alternatives here for other structures to emerge? Can U.S. companies kind of take the lead and say, okay, if the public markets aren't going to be welcoming to these ideas, we can nurture them and use, turn what these guys have created in the garage into, a billion-dollar business, that Apple can leverage that, produce it globally, turn it into something that everybody in the world wants to buy. Are there other opportunities out there right now that we should be exploring to get back to job creation?
Well, I have a couple thoughts about that. One is that I actually think, on a more positive note, because I know this is a bit of a rainy conversation, I actually think that we have a unique advantage in this country with respect to the fact that we're open to private capital in a lot of ways. If you look at the institutional investors in the U.S., their allocation to private capital, which some call it alternative investment, but to private capital, is much higher than anywhere else in the world. What we're seeing now is also the emergence of more regions in the world start to turn towards private capital. Let me give you a couple of small facts. The average large pension fund in the United States will have an allocation, or an endowment like Georgetown, will have an allocation to alternative investments or private capital of about 10 to 12%. In Europe, that's about 6 to 7%, and in Asia, that's around 2 to 4%. Europe and Asia are growing quickly. In just our experience over the last few years, 85% of our capital used to be from North America. In our last few funds, it's been 60%, and that 40% has been filled in. We have an opportunity because the private capital system in the U.S. is quite developed. And I actually think the ability for entrepreneurs to find funding, short of being the size that you go public, is actually quite good. And if we can, I also think at the same time that has been a lightly regulated industry that really overgrew over the last 25 years. And so the SEC, rightly so, is starting to take steps forward towards regulating the industry, which I just view as a good thing. Because I think people want to know what they're going to get when they make those investments. But I think when you think about job creation, there's a creative destruction cycle in the United States that's very, very important when it comes to job creation. And by that I mean this. If you look at large cap companies, over time they actually decline in the amount of jobs created. But new divisions, new products, new regions, or new companies entirely are really making up more than 100% of the job growth in the United States. If we can foster that environment, you can get there. Now, one of the issues is the fight over Wall Street has spilled into some of the capital markets and some of the private markets, and we start to hear things like, well, maybe we should just not allow pension funds to invest in private equity. Well, that's a problem for those pensioners because it's their highest returning assets. That's a real problem for Silicon Valley and other places where that private capital goes to. So understanding that private capital has become really the engine of innovation in the United States. Now, by the way, innovation after the Second World War, driven by the defense industry. Many, many American high-tech companies were driven by the fact and the investments that they had. That's been replaced over time, for a while, by the public markets, and now more and more private capital. We need to be cognizant that that's a key growth engine for jobs, and figure out ways to regulate it in a way that's symbiotic rather than saying, well, they should be, private firms should be regulated by banks, because that will kill it off. We have a chance to take advantage of that globally. The capital's coming in. It's an advanced capital market systems, but we have to be sensitive to over-regulating it, frankly.
And there are some emerging structures, like for example, crowdfunding is something they're trying to sort of work out exactly how it should work. Part of the, as LT mentioned, that regulators have been looking at these markets and trying to impose a little bit of structure. Kathleen, do you think we've made progress, and are some of these kind of private markets maybe in a position to begin to provide some of that capital, but also in a way that gives investors the protections that they might need to draw a little bit more money in?
Yeah, there's no question, and crowdfunding being, one of the key issues that the SEC is currently looking at, and you've seen a lot of support for facilitating, both in Congress and also by the administration. There are issues that are raised, about concerns about investor protection, and I think that the key issue there, though, is going to make sure that in addressing, legitimate and fair concerns about investor protection, that you give consideration to the fact that you don't want to over, as he said, the danger of over-regulating and potentially unduly dampening the market. So I think that there has to be a view that whatever works in the public market necessarily doesn't work in the private market. And I think you do see, while you talk about the trend and growth in the private markets, which I think is symptomatic of some of the weaknesses in the public market, while you want to make the public market, continue to make the public market attractive, particularly for small and growing companies, you also want to facilitate allowing them to continue to tap the private market and actually enhance their ability. And there are several proposals that are being considered there which would allow companies to stay private longer. and allow them to look at trading on some of these new platforms. Although again, there are some, there are investor protection questions that are being raised. And then again, facilitating innovative ways like crowdfunding. But those are things I think that can be scaled, and that's how I think that the commission and policymakers need to think about it, and balancing, continuing to allow the private markets to play the role that they have.
Do we have any other audience questions? There's this gentleman here.
In terms of private equity, there's about $1 trillion of unspent capital in private equity that's waiting to be deployed. How it gets deployed. So this question really is for both Mario and Laurence. And that's levered, say, a couple times. So $3 trillion of acquisitions could potentially be made in the not distant future. And it's been pretty slow, and private equity has been, I guess, fairly responsible through a lot of this crisis. But equity markets are relatively fairly valued. I think that's probably the common wisdom. How does that all sort of play out in your mind, Laurence, and also in your mind, Mario, as you're investing sort of around it and with that big gorilla in the background?
Well, that's certainly one element that one looks at. If you have a public company that we own, we look at what's the catalyst and what's the private market value. So when we buy something, we're trying to figure out what the model is of LT's company and try to reverse engineer it so we understand what they would pay for the company both today and 5 years from now. And to the degree that company A is bought, and every day you come in, for example, Thomas & Betts was selling at $57, somebody offered $72. So I don't think the market's fairly valued. I think somebody might academically tell you that. But within the context of specific companies, today Shell Oil just paid 70% higher for a company that found oil somewhere off the coast of Mozambique. So there's a lot of opportunities. Some of these private deals, they just sell to themselves again because they have a 10-year life and they have to invest it at the end of 5, and then they have to harvest it within a certain period of time, and they don't get the carry, or the carried interest, I should say. So we have a lot of the, just trying to warm you up, LD.
I got it.
So I just think that's wampum. But, when you look at Nestle's, they have $20 billion market EBITDA. They have a 1.2 times turn. Will they buy Mead Johnson, okay? And so I think private equity is interesting, but it's not the end game. And the question before about the amount of cash that someone has offshore, American companies were abusing the system by basically looking at tax countries, doing some interesting accounting work to move their cash offshore. Why should we give them a holiday to bring it back? We should just lower American corporate tax rates so we wouldn't have gone offshore in the first place. Sometimes some common sense is needed in the process of legislation.
I think I know what you meant when you said unloved.
I didn't want you to be ignored, though.
No. I have a couple thoughts about that. I think that what really happened is when there's turmoil in the markets, the longer-term private capital investors tend to be a little more timid. For the reason that Mario said, we tend to live with assets for quite a long time, and it's difficult to guess, because if you guess and you miss, it can be difficult. There is record level of private capital available in the private equity industry here in the U.S. right now, which is a good thing, I think, but it's a hard thing. It's good for sellers, it's bad for buyers. So what's actually, at least for us, what's happened is we have, since the time of our IPO, which is now coming up on 5 years this year, spent as much time as we could diversifying our ability to source deals, not auctions, and to source deals around the world, not the United States. There's a second part of that bet, which is when you have, and this is a whole different discussion, but when you have your debt to GDP after the crisis that we have now, math says that growth in the United States will be very slow, moribund really, for an extended period of time. So you're going to need to find other places to be able to find growth. So my observation is I think you're absolutely right. I mean, what I've seen in the last 12 months of capital chasing deals that as soon as I know it's an auction, don't really return the book or the NDA and move on. Because there's a lot of capital out there. But wouldn't you say, Mario, there's a big delta, I think, between what people think is fairly valued today and what's not. And some would argue that the markets have seen more of a financial recovery meaning that their value is at Dow 13,000, versus a fundamental recovery, meaning that the actual underlying organic growth in companies is not happening. I think always big corporates, by the way, doing acquisitions when you're in a big corporate in most industries is a high-risk game. And when the rewards are uncertain, it pays to sit on cash. I pulled out a stat today, which I think is pretty interesting. So I'll add to there's a lot of private equity capital out there. U.S. companies are paying, right now, the S&P 500 is paying an average yield of 2%. They're retaining more capital than they have since 1871. So this is definitely still a reaction, and companies are holding back. So capital will come. The question is where and when. I just don't know, but there is a lot of capital chasing deals.
Got a question back there that was very patient. Go.
Thank you. My question for you is, you guys have made a very good case for why regulation in the United States is choking some of the business development. My question is, around the world, there's also regulation that's coming along that's maybe a year behind, 2 years behind. If you look at Europe, the FSA stuff, if you look at all the debt markets in Europe, as well as in Asia, there's a lot of rules coming too. Do you think that this is the new equilibrium, and 5 years from now, you won't have a place to go to with your capital?
So the question really is there more regulation that's coming around the world? I think it is. You know, again, when I talked about my spread, it was the US markets were well regulated, well structured, and the other countries, in a lot of other countries, that was not the case. And now everybody's put in the basic infrastructure, and so you can trust the markets. There's more disclosure, there's more transparency. So that's happening. I mean, Basel III, it's not just US regulation, it's international regulation. There's convergence in regulation, whether it's the SECs of the world that meet through IOSCO and try to converge, or it's banking regulators, everybody's trying to converge. Having said that, Dodd-Frank is pretty unique, and Sarbanes-Oxley is pretty unique.
I guess I'd add one thing to that, which is I think, and Kathy, you're really the expert, I think we had a somewhat unusual regulatory regime going into the crisis, in the sense that probably our largest providers of capital in the investment banks and the large banks had a diversified set of regulators. So if you look at the Bear Stearns and the Lehman Brothers of the world, they were a bit of an orphan. They had regulated entities by the SEC. They also had the CFTC, and sometimes they had, other types of regulators for their deposit banks. And I think that was relatively unique, that we had, I think, what was it, 7 regulators?
But LT, they went to 40 times leverage.
Well, I was just going to say, so now you know that they don't have a parent.
Yeah,
Now leave them alone with gas and matches, and
there we go.
No, I mean, I was just going to follow up on LT's point that, interestingly, I think that's correct. I'm not aware of any other jurisdictions that have as many, both banking and capital markets regulators. Certainly for these, have both the CFTC and the SEC. Many of them are consolidated regulators. And even as far as the central bank having a regulatory function. Interestingly, early on, there was a thought given to basically consolidating regulators. So there really was some thought given to trying to change the structure of oversight of the markets, which I think there was a lot of good appeal to, both with the Treasury. There's a Treasury blueprint. You can agree or disagree with how they split out some of the responsibilities and the model that they ended up adopting, which I think was a Twin Peaks model. Which is Australia, I think, also follows that. But even after through the crisis, when Congress was giving thought to, what are some of the most basic things that we really need to do to address this, structural reform was one of them. And unfortunately, that got sort of lost by the wayside. And my personal view has always been that, I always thought that aside from, they wanted to have just a single prudential regulator for banks, was to merge the SEC and the CFTC. I still think that has merit. I think it'd be very difficult to do, but it's certainly, I think, given the fact that the integrated nature of the markets, and the fact that we're writing parallel rules, for example, even though we have the SEC, I don't have anymore, I'm a former Commissioner. But even though you have a smaller section, a smaller responsibility for securities-based swaps, and the majority of the market will be regulated by the CFTC, again, it just, does that continue to make sense?
Well, unfortunately, we've got to wrap up the kind of the formal part of the evening, but I think that we address kind of both the structural issues that are facing a lot of companies trying to raise money both publicly and privately, but also some of the, I think, not to be lost, the cyclical concerns as well. That part of the uncertainty is that investors aren't willing to gamble on smaller companies that, you know, like LT said, if you guess and get it wrong, you know, the consequences can stay with you for a long time. So I think on that note, I'd like to wrap up and thank everyone for joining us. And I'm sure that the panelists will field questions for a few minutes afterwards as well.
By the way,
Thank you, guys.
there are free copies of tomorrow's Financial Times available for our guests outside.
I want my iPad subscription for a year.
Use tomorrow's information wisely.
Good to see you, Telis.
Good to see you.
That was terrific.
That was great.
Great.